So Jim, I hear your son's been listening to our podcast. Did I hear?
Oh my God, yeah. He had an episode on a bus trip that he'd listened to, and he didn't hate it, which was great coming from a 22-year-old. And he actually said that he stayed because it was an enjoyable conversation. The advice really didn't apply to him.
That's huge, honestly. I mean, that's 22. You said 22?
Yeah. Yes.
All right, huge news.
We're officially podcasting.
We can wrap this whole thing up now. Yeah, exactly. We're not going to top this. Were those his exact words? I didn't hate it.
Those were my exact words to him. Was, did you hate it? He's like, no, it wasn't bad, and I was just listening because it was you. But I stayed because the conversation was pretty good. And he also did say that it really didn't apply to him. But
it was definitely the retirement one.
Yeah, it was a retirement one. Yes.
Is that the first time he's listened to you, Jim?
Yes, that was the first time he had listened to the. Oh yes, absolutely. In 22 years, that was the first time. That was the first time he listened to me. That's correct.
All right, but we have a new face here for the podcast, a special guest who is going to go over all the ins and outs of intra-family loans, that is to say, lending between family members. Jon McGowan, a partner at Liff, Walsh Simmons, has graciously agreed to join us for the day. And I'm just wondering, I feel like, John, you were talking before we got on tape here, how Jim managed to wrangle you onto the show.
Yeah. Well, first of all, like, long time listener, first time call. Is that how you say it?
Yeah, I think that's the coast to coast AM how you call in.
And it's really cool to see your all technology upgrade. I'm not seen these microphones before, but the only thing that hasn't upgraded is Zach's background. It's still yeah. At least like open it up and let's see all the jerseys or the
No, there's not.
What is in the closet?
Yeah, Blazers, you flatter me. There's nothing to open. This is corrugated cardboard. It's just, in the closet pattern.
Oh my God!
Had a lot of viewers write in saying that they enjoyed the closet.
It adds intrigue and mystery,
right?
To the show.
What's he keeping back there?
Yeah, every time I just want you to open it up. But yeah, I've watched a lot of these and they're really great. It's I'll tell you a story how I got recruited. I'm actually gonna read you Jim's email. This is what he says. He says, "Hey John, I hope you're doing well. I'm looking for some knowledge on family lending. I have a client who asked me about providing a mortgage to her daughter. Do you have any guidance on how to structure a transaction like this, assuming it is well within the means of the parents? Let me know if you have any thoughts." And I get this. I'm like, oh yeah, great. I'd love to work with your client. So I respond to that end, and then he said, "Great. Would you like to be on a podcast about family lending?" I said, "What about the client? What is going on here?" I got roped in.
We have so many listeners.
Jim failed to explain that his client is a podcast.
That's right.
Yeah.
I was really looking for some free advice for my client. John wanted like a whole meeting set up and so forth. So I got to change his direction. Let's get on the podcast.
Yeah, no, but happy to join you guys, and I'm really looking forward to the next 30 minutes or so.
Yeah, we are as well. And John, before we dive into the meat of the conversation, I was hoping that you might be able to just give a little bit of a background on yourself and what you do at Liff, Walsh Simmons, and how it all plays into family lending.
Yeah, so I'm one of the partners here at Liff, Walsh Simmons. I've been here for about, I guess it's been about 11 years now. And the firm is a boutique business law firm here in Annapolis. We specialize in small to mid-level businesses and their owners. And so we have everything from commercial litigation to business planning and transactions, estate planning. We do a lot of real estate. We have an associated title company. So that kind of we kind of share a common core customer with you all. My practice in particular is business planning and transactions, and then also estate planning and trust planning. So I feel like those two usually you're having similar conversations with all of those clients, business owners that want to transfer their wealth or their estate on to the next generation as well as the businesses. So that's kind of where I where I hang my hat, and been doing it for quite a while now.
Excellent. Thank you for that primer. And I wanted to bring it back to that initial bait and switch question that Jim asked you regarding the mortgage loan from a parent to a child. Jim, Jake, when you think about family lending, so lending from one family member to another, specifically parents to children, is it often in the context of a lump sum of some sort, like for a down payment for a house or for the purchase of property, or does it tend to vary?
Yeah, I would say that's really when it comes up, is if a child is looking to make some sort of big purchase, and the parents has the resources available to make that or help them with that purchase, and so it maybe the child really isn't at a point where they can actually afford it, or maybe they can, and maybe their assets are illiquid or something like that, and so the parent steps in and says, "Hey, I have some assets available. Let me lend you the money. You pay me an investment return," and it's a win-win sort of situation. So that's where I've seen it for the most part. Jake, I don't know if you've seen any other situations with the family lending piece.
That's where I see it most commonly. And I really enjoy these questions and conversations with clients, because it's usually coming from, this kind of benevolent place in their priorities. And ultimately, these conversations tend to turn to an exploration of personal priorities. And so even if kind of the basis of the conversation or kind of starting out is, okay, my, child or close relative, needs a lump sum for a certain large purchase. Maybe it's down payment on a home, maybe it's an education, related, whatever it is, usually there's kind of a catalyst event for giving, but then it opens the door to say, okay, this is something I want to do. Maybe I want to do some more of this. How can I structure in giving over the rest of my lifetime? And so I really enjoy those conversations, because it's one of those kind of door openers to a bigger conversation on priorities.
One of the first questions I had on my list was, sorry, John, was, what's the purpose? A client comes to me and they says, "Hey, I'm thinking about doing this." That's really the first question we want to dive into, Jake, just like you said, is what's the purpose of this sort of transaction, or how to get started?
Yeah, absolutely. One of the other things I wanted to add is you often see them sometimes when a parent is passing on a family business and they want their child to buy in some ways, just to make sure, a lot of this is equity amongst multiple children. And so using intra-family loans to make sure that value is actually paid into a family business like that. And then, if we want to work in a gifting strategy to take up the $16,000 per year exclusion amount, we can do that after the fact, but let's get the loan in place first, and then we can backtrack from there.
And I think I kind of even just shifted in my mind to maybe not what the question was, focus more on gifting rather than lending. And we'll talk a little bit more about lending. And a lot of times when the question comes up, at least when I get it, maybe should I loan my kid some money? How much? What are the, parameters we should kind of set forth? I think it still ends up being kind of an exploration in priorities. But I think tongue in cheek, I like to kind of use a little expression. Maybe it's kind of a joke. What they call a loan to a family member.
Yep.
Yeah.
Yeah.
Right. Yeah. It's one of those things where I think a lot of times the conversation does start off with how can we structure this objective as a loan, and sometimes that is absolutely the path forward to aligning their objectives with what their children need. But sometimes that conversation does shift as they begin to explore priorities. Okay, I don't really want this as a loan. Can I do it as a gift? And then I think we get to the question, okay, should we structure it one way or another? And that's where, John, I think someone with your expertise is essential to really help kind of once you get to that point in the conversation, especially, how should we proceed?
Yeah. It's a number of different factors. Jim mentioned what is it for first and foremost? What is the liquidity of the parents? Can they even afford to give this lump sum? You guys talked about retirement a couple of episodes back. How does that factor into their retirement picture if they're giving this lump sum? And then also the tax implications of the gifts. Like I just mentioned a moment ago, each person has an annual exclusion amount of $16,000 that they can gift somebody. You add a spouse to that and you double it. But anything beyond that essentially eats into your estate tax exemption at the end of your life. So just a multitude of different factors as to why you would structure it one way or the other. And it's important to kind of take a zoomed out view first before diving into the details.
And John, that was something I wanted to specifically ask you about, because there's clearly a category difference between, a family loan or any loan, but, specifically a family loan and a family gift. And you mentioned liquidity just a moment ago. Is that one of the driving factors for whether you might make something a loan versus a gift? That question of liquidity on the part of the lender or the gifter, or are there other factors at play that you've seen?
Yeah, absolutely. I mean, I think the family business is a great example of, hey, you want to transfer control over to your son or daughter of this family business, but at the same time, you're not really ready to give away the revenue that it generates each year, and so you structure it that way so that you're selling the business to the child, but at the end of each month, each quarter, each year, however you structure it, you are getting essentially paid off the revenue generated with some interest factored in there. So cash flow for the parents is obviously a big factor as to whether or not they're going to want to structure this as a loan as opposed to just giving either the business or the asset away to the child.
Yeah, I would just add to that, you got to make sure in these situations, because Fannie and lending gets a little dicey, you got to make sure that both parties are on the same page. You might have a parent that's looking for a revenue stream, like John just mentioned, and then you might have a child that's looking for a gift. And so it's really important not only to figure out what the parent's perspective is and the reason they're lending money to the child, but also what the child's expectation in terms of paying that back. And that's where I see some of these things potentially causing some maybe some family issues or the potential to cause some problems.
Mm-hmm.
Just sort of on its face, as a matter of practice, how do you find that out? How do you figure out if parents and children are on the same page there?
That's a good question. And a lot of times it boils down to a lot of questions, and your relationship, and how well you know the parties involved, and it's number one, figuring out what the parents' intention is, and you usually have the relationship with them, and so you can ask a lot of questions, what they're trying to get out of it, and then maybe from experience you can or historical experience, you can sort of make a prediction what the child's perspective is. Are they responsible? Do they pay their own bills? Have they accumulated their own resources? Have they borrowed money in the past and not paid it back? So you might have to make some inferences in that situation if you don't have a direct relationship with the child. But you can definitely, whichever party you're working with, you can ask some really good questions there and dive deeper.
And Zach, in addition to the additional fact finding that Jim's talking about, it's also just, and we'll talk about this later, but observing some of the formalities of the transaction, whether it's with proper documentation or even treating it as a legitimate closing, to get all the parties in a room so that it's treated as arm's length and so that everybody has the same expectations. I mean, I think the easiest way to have a communication breakdown is to not document these things. And there's other reasons to do that, and we'll talk about that later. But yeah, I think observing the formalities is an easy way to make sure everybody's on the same page.
John, in your experience, as Jim's talking, as you're talking, I'm just kind of thinking about, some of, this type of situation, with a family and, certain expectations being set. And I think if I'm hearing you right, John, it's in your experience, kind of operating more kind of in a black and white world, procedurally. Mm-hmm. Does maybe a more effective job of kind of setting those expectations for everyone involved, following all the rules that you need to be following. And maybe if you start kind of operating in the area, kind of the gray area, if you will, that's where a lot of confusion and potentially, procedural pitfalls lie.
Absolutely. And it's easier for some parents or family members than others. But at the same time, if you need the attorneys to be the bad guys and say, well, that, they say I need to get this signed, or they say I need to get payment, on this date, or make the IRS the bad guy. If you don't pay me, it's going to be considered a gift or something like that. But yes, I think it's definitely being a little bit more black and white and avoiding those gray areas for sure.
So we're going to throw you under the bus at every opportunity to clear up all family disagreements.
That's right. That's what we're, it's funny. That's literally one of the few areas of law that we don't do is family law, so don't call me for any child support or divorce actions. I'll kick that to one of my colleagues down the road.
Well, when our family lending strategies, need close attention and someone to throw under the bus, we'll head your way.
Yeah.
And that's but Jake, I think Jake's raising, I think a point that I'm interested in, and I think a lot of our listeners would be interested in as well. I mean, even if we're keeping things within the realm of of transactions and at arm's length and following the clearly documented contractual language that is sort of orbiting family lending strategies, emotion is still there. These are still ultimately individuals with fraught or less fraught relationships with each other. And Jon, I was curious, in your practice, what are some of those emotional ramifications of family lending? Even if everything is followed to a T that you've seen, and if there is emotional fallout, how can people best mitigate that if they want to enact one of these strategies?
Yeah, I think money in among family, whether it's in family businesses or in transactions like this, or whether it's parents, giving money to their adult children unequally in the children's eyes, it can lead to a lot of frustration, especially. And it seems like the more money involved, the more frustration that can come out of that. And so it's some of those things that Jake just mentioned and we had just talked about, is just making sure everybody's on the same page, and being careful to structure it the right way. One of the things, an example would be actually document with an actual promissory note that, so if something happens to mom or dad, it is an asset of the estate, and it's still something that son or daughter needs to pay back, and it's known amongst the family that this was still treated as a loan. And then the same thing is keeping at arm's length, making sure there's an interest rate, structured payment, things like that. I had a client that had called me recently about a loan from his father-in-law, and it seems like in-laws is also a trigger. You never borrow money from your father or mother-in-law, but there was
that's the name of the episode, by the way. We've already just decided.
That's it. Yeah, absolutely. Make it for an awkward Thanksgiving or Christmas. But the interest rate or the payment amount in the actual note said one thing, but the amount that he had been paying over the course of the last few years had been something entirely different, and it led to, wait a minute, you're supposed to be paying me this much, you're not paying, and it's just making sure that everybody's doing what the documents say they should be doing, so that nobody can really get frustrated with the quote unquote deal that they struck at the beginning of this. And it all sounds very black and white, like you said, Jake, but I think the more you keep it that way, the better. But I think some of the frustration is unavoidable to some degree. You're dealing with close relationships and money.
Yeah, and Jon, as you're talking, kind of describing this, I mean, I can't help but think just falling back to kind of what we were talking about earlier, I mean, needing a source of accountability for both parties involved. So the person who's lending the money, the person who's borrowing the money, having that understanding written out, but also having a third party who's objective to the situation, who's making that attempt to set those expectations and follow the set of rules. They're also there. And I don't know, maybe this is the most important component in a lot of relationship dynamics, but having someone there who provides the accountability. I feel like, and I've seen it firsthand. I mean, you get these documents, you draft your own promissory note, you're making a loan to a family member, you're doing it behind closed doors. Even if you're attempting, to follow all the kind of procedural rules, you've done it behind closed doors, and you can bend the rules at your convenience. And I think that's baked into the expectation in some ways. And I don't know, I mean, what's your experience around that and seeing kind of these, family loans kind of drafted behind closed doors? Do you see maybe these kind of blowing up or taking a turn for the worse more often than in situations where there is a third party source of accountability like yourself?
Yeah, well, and the other thing too I mentioned before is the IRS. Like, there's no question that these one of the benefits of intra-family loans is the flexibility for repayment options. The good interest rate that you would receive on that. But the IRS does hold you accountable to make sure that these are actual bona fide loans, so that they're not considered a gift for estate tax and gift tax planning purposes. So some of those requirements, like we talked about before, just properly documenting it with a promissory note. Sometimes they, if it's for acquiring a piece of property, a lot of times they want to see that collateralized with a deed of trust or a mortgage. Or if it's for a business, they want to see a security agreement, UCC1 filed. And they want actual repayment schedule and fixed maturity dates and things like that. And the last but not least is the applicable federal rate that they require you to charge. And that's put out by the IRS monthly based on the market. And it's usually a lot better than you're going to get at the bank branch down the road, but it's still going to be something equivalent to what the market reflects now. And so if you're doing all of those things, I'll say it this way, you already have to do all of those things, for fear of audit risk from the IRS. And so that can be the thing that holds everybody accountable to acknowledging, hey, this is the structure we agreed upon. We can talk about forgiveness or things like that down the road, if it fits within our gifting strategy. But this is the baseline for us to operate under.
And how do you handle, in your practice, John? I mean, if a family loan is structured in a way, okay, it needs to be a loan, but we're going to try to fold in and incorporate some element of forgiveness each year. Have you seen that kind of break apart over time and say, okay, we don't want to, provide this, forgiveness amount each year, kind of contribute our annual gift exclusion amount towards that forgiveness and kind of change the dynamic in a relationship, kind of midstream?
Yeah, I haven't had too much experience with that becoming an issue where you started under this operation. And then, I mean, it kind of starts with, one thing I'll say is it's important to have all the players on the same page. I think, Zach, before we got on the call, you mentioned when do we get the financial professionals and attorneys involved. And I think it's really at the outset, so that people like you, Jake, and Jim, and Zach can do an analysis of, like, how does this fit within our husband and wife's or mom and dad's plan, and then each year, making a decision as to, okay, can we afford to maybe forgive a portion of this? Does it fit within? And then also the accountant has to be has to be on those conversations as well. So it's all the players getting involved and then having the attorney document it, with a forgiveness letter or something like that. So because it's a hard thing to operate under one expectation and then change it to the borrower's detriment.
Yeah.
So I would say less is more with that perspective. But if it's needed, it's needed, obviously, and just figuring out a way to properly document it along the way.
This may be of interest to nobody else, save for the tax nerd inside me. But I am curious, just because we're talking about loan forgiveness. If an intra-family loan is ultimately forgiven by the grantor, by the parent to the child, would the child have to pay tax on the amount of loan forgiven as a shed liability, or would it be counted as a tax-free gift for the person who's receiving it?
It's the latter. It would be considered a gift. That would be the severe couple tax ramifications of this structure. First and foremost, the interest that the lender or mom and dad or brother or sister, whoever is lending the money, receives each year is obviously taxable as interest, just like anything else. But the big risk is if it is forgiven, it can result in what we call gift tax, and really gift tax is a problem for those in the higher level of wealth, where we're talking about, between mom and dad, that's 16, that's 32,000 per person a year that you can gift, and then anything above that will start to eat into your state tax exemption, so to speak. And at the federal level now is at 12 million per person, and then in Maryland, where we are, it's 5. So this is it's not a huge concern for a majority of Americans, but it definitely can be when you talk about, if we're transferring a significant amount of wealth to the next generation or even grandchildren.
Got it. Thank you for indulging me. And we were talking a moment ago just about when do the attorneys get involved? And you said, well, that's at the outset. So everything is clearly documented and communication is strong throughout the entire process, and everyone knows what's happening, what is going to happen. But I'm also curious about what kinds of circumstances might require the involvement of an attorney, and the answer might be, well, always. But is it about a certain threshold amount of money being in play, and that's when you would want the aid of a legal professional, or is it a kind of transaction such as a business transaction where you would want the attorney to be involved? I guess what sort of categories of loan might someone who's thinking of providing one to a child say, okay, I should get my attorney on the phone, I should get someone to work on this?
Yeah, I'm not 100% sure on this, so somebody's going to write in and fact check us, but I think it's anything over 10,000 is when the IRS requires it to be, those bona fide loan terms that we talked about. So if it's under that, then you can lend your son a couple $100 here and there, something like that. But I think attorneys get involved. They get involved to document and then to litigate. Frankly, if there is some planning that goes on. A lot of times it's hand in hand with the financial advisor or the CPA. But most of the time, in my experience, the strategy usually is developed with the financial advisor and the CPA, and then ultimately the attorney is brought in to help document it, make sure that everybody's on the same page, like we talked about, and make sure that we're not stepping into any issues with respect to the interest rate charged or not having a maturity date or things like that. And so usually it's the last person you call, frankly, because there's usually the higher hourly rate. Unfortunately, that's the kind of rep we get. So we're usually called after the problem arises, and not usually to prevent. So, but I will encourage people. It is always cheaper to have an attorney involved earlier than have to litigate, and that's from a financial and an emotional perspective as well. Like I said, these things can drag out for years, especially when families involved. If there's any falling out.
Now, I was actually,
Jon,
I was actually a little pleasantly surprised when I reached out to Jon to get his input on how to document it. And Jon, I think I heard you reiterate this. It's really just two pieces of documentation that you guys prepare. It's, from a simple perspective, if you're not involved in the planning, and so it's not a ton of hourly rate that you're charging for this sort of transaction. It's really just preparing two documents and making sure everybody's on the same page. So I have that correct?
Yeah, absolutely. So, in the most common situations that I come into this is with acquiring property, because with the interest rate, closing costs, things like that. If mom and dad have the liquidity to loan me money for this piece of property, they're going to make money on the interest first and foremost, and I'm going to save money on all those closing costs. So that's the most common. And in those situations, it's a simple promissory note. And then what we call here in Maryland, a deed of trust that you record in the land record that actually acts as a lien against the property being acquired. And then the recording of that document, and really not much more. And Fannie Mae, Freddie Mac have the standard form that a lot of times we operate under. The only time it can get really complex is if the repayment terms are odd or any other terms of the loan are require some unique drafting. But yeah, in most cases, Jim, it is pretty simple. When we're talking about loans in relation to transferring a family business over to the next generation, that can be a little bit more involved because we're actually doing the transfer document for the business interest, whether it's stock or membership interest. But yeah, so it depends on what we're talking about, but for the most part, it's a proper promissory note, and then whatever collateral document that you're using to secure the loan. So yeah, it's nothing. It's not you're not going to be spending a lot of time in our office to get that done. It's more just the planning in advance with you guys, just to make sure that it makes sense for the client's perspective.
So doing it right the first time around pays off in the long run.
100%. You can ask one of the litigators down the hallway and how much did you save from doing it right the first time? That's for sure.
Do you have any, I don't want to ask for horror stories, but do you have any kind of examples you could give us for kind of where intra-family loans have gone awry? Kind of what are some common circumstances where you see these, kind of falling apart, and kind of what that looks like in a litigation circumstance?
Not too many. The one I just mentioned, although we didn't get too far in the weed with that one, but you just wouldn't believe, especially in the state administration area of our practice. We do a lot of estate litigation as well, and that old adage, like death and money really change people, is so true. People will spend way too much money fighting over these issues out of spite and because family is involved. So that's where it kind of goes back to what you're talking about, Jake, about keeping it black and white so that everybody's expectations are the same, not only between the parents and the borrower, or the son or daughter that's borrowing the money, but their siblings as well. It can be a big mess when it comes to administering mom and dad's estate, and there's some undocumented loans from mom or dad that the siblings have different viewpoints on. So we see it a lot, but and a lot of times it can get pretty costly.
Would it be also a fair statement to say that simplicity helps you to stay kind of in that black and white, and kind of the further you delve or dive into more complex transactions, kind of the murkier it gets.
Yeah, 100%. If you're changing the payment terms from year to year or things like that, it can start to create wiggle room, so to speak. And so, yeah, it is, the more simple you can keep it, the easier it is for everybody to maintain the same expectation.
I think we're going to have to leave it there, given where our recording clock is at. But it seems like the key takeaways here are get it right from the start, and do not borrow from your father-in-law.
Yeah, 100%.
For those who are considering an intra-family loan.
You've taken enough from him already. Yeah,
That's right.
that's right.
Exactly.
Really helpful, John.
right.
Hopefully,
Well,
hopefully we get you some real advice, and it won't be on a podcast next time I reach out.
No, this is way better. This is a lot more fun. Just hopping on, spending an hour of my afternoon just hanging out with you guys. This is great. No wonder people do this. No wonder this is such a huge huge wave of media.
Since yeah, exactly. You wonder 1,000 podcasts get launched a day or whatever.
Even 22-year-olds will watch.
Yeah. Well, they watch a different podcast, but actually, I was telling somebody the other day, regardless if somebody actually watches this or not, I have fun doing it, which I never ever expected. To your point, yeah, it's good just having a conversation.
It's like therapy.
That's right.
A lot of fun.
This has been therapeutic. I've validated all the thoughts that I had about intra-family loans. So
Therapy at a fraction of the cost. Who could say no to that?
Well,
All
you'll get the invoice shortly, but
we'll split it.
Stop the clock.
We'll be able to split it 3 ways.